Hey guys, you're back with Steph and Dennis, and today we're here with another investing video. You may have seen our recent video all about trading basics or active investing, and as promised, today we're here with more Investing 101, but specifically focusing on how to do passive investing. So we're gonna take you through what passive investing is, what your options are, everything you need to know, and actually how to get started with this form of investing too. So if you're excited for this video and more content like it to come as well, show us some love down below. As always, hit that subscribe and like button, and let's get right into it.
Okay, so like Steph just mentioned, a couple weeks ago we did a video all about trading, and we basically just went over what trading was. We talked about how traders try and outperform the market. And once again, we get it. It's super enticing to pick those single stocks, especially when you're living in an environment where growth has been hyped up. There's all these high flyer tech stocks running around. Basically, it's everything that you're seeing on TikTok. So today we just want to go over the basics of passive investing. And like we've seen in previous research, or even in that last video that I just mentioned, 80% of actively managed funds do not outperform passively managed investments. Now, knowing that, and for the vast majority of retail investors, this is probably where you want to ask yourself whether it's best to take the actively managed approach or the passively managed investment approach. So as it's hinted in the word passive, the idea behind passive investments, if they're implemented correctly, is basically less work, you get less manual error, and on top of that, you should expect higher and more consistent returns in the long term. And once again, especially when it comes to money, you're gonna have people coming from all different backgrounds with all different types of views. But if you've been tuned into our channel, you'll know that we do put our money where our mouth is, and you'll see that the vast majority of our money, our income, goes towards those passively managed investments. And it's kind of funny because we've been getting a bunch of questions recently on why even bother investing at all? Why don't I just put my money into savings? You know, if you put in a high interest savings account, it'll be inflation proof, you're good to go. And I really think a lot of this, these emotions and these questions come from not really knowing the impact of investing, especially over the long term. Basically, by the end of this video, we want you to understand how important passive investing is. And Steph's actually gonna walk you through her platform and show you basically how straightforward and simple it is to use.
So like Jen just mentioned, and we mentioned in our past trading video, passive investing is a safer option than active investing. But passive investing is riskier, of course, than saving money. So at a high level, and if you live in a country with good monetary policies, then saving is basically guaranteed, meaning that if I earn money and I put it in the bank, I basically know for sure that it's going to be there. But as much as it's guaranteed to be there, I'm also guaranteed that I'm not going to make a substantial amount of money on top of that money that I put in. So my money isn't going to grow by very much at all. So I'll walk you through an example of that so you can visualize it. Let's say you had $50,000 in a checking account today. 20 years from now, you would still only have $50,000 in that same checking account. And something I want to point out is that that's not even necessarily true. Because inflation rises over time, your purchasing power on that $50,000 decreases. So if we look historically, if you had $50,000 in 2001, that's actually only equivalent to $34,000 today. That's a whole other topic that I just gave a really high level example of, but more on that another time. So again, for the sake of this example, $50,000 today in 20 years is still $50,000, quote unquote. But if you were to put that money in a high interest savings account, so hopefully at about 2% interest, and again, we always have our recommendation of the high interest savings account that we use linked in the description box below for you. But again, if you did put $50,000 today in a high interest savings account at that 2% rate, in 20 years, you'd have about $74,300 instead of that $50,000. And then if instead of doing that, you actually passively invested that $50,000 in relatively low risk investments, so let's assume a 6% annual return, that $50,000 now turns into just over $160,300 instead. So to sum that up, that's $50,000 or actually less versus about $75,000 versus $160,000 plus dollars. And again, that $160,000 passively invested is still your money being invested in its most simplest form, basically on autopilot with you not doing much to it at all. So now if you're thinking, okay, that sounds great, but where's the catch in that? How and why am I able to earn that much off of my money? And the answer there is that there is no catch. There are real and explainable reasons to show why your money is growing. And again, today as an example, and to keep it at a high level, we're gonna focus on growing your money in the market. Now, the market is made up of all of the companies publicly traded on the stock exchange. So companies ranging from TD Bank to Apple and Amazon. And in the short term, term, these companies will of course grow in dollar value at times, they'll lose money, and everything in between will happen to them. But in the long run, if you do invest in all of these companies, which sounds kind of crazy, but you can do by investing in index funds, ETFs, or mutual funds that actually track the entire market, you'll see that in a long term, they actually collectively do grow at an average annual return of 6%. And again, keep in mind that that number is an average. Of course, some years will be less and some years will be more, but overall, that's why you're keeping your money in there for the long term so that you can get to that average higher amount. Now, keep in mind there are other ways to make money from passive investments as well on top of these capital gains. So you can get dividends paid out from specific companies, and also the concept of compound interest accumulating over time. But again, those we can get into more in a future video because we want to keep this one as simple as possible. Okay, so now let's regroup on where we're at so far. Hopefully now you're on the same page as us and you're thinking, okay, investing is important to grow my wealth over time, and I should see average rates of return over the long term.
Okay, so step one in making things happen is figuring out where you want to invest or who you want to invest with or through. So for the sake of simplicity, we're giving you three options. Option number one is going to be your bank or a financial advisor. Option number two is going to be what we call a robo-advisor. And then option number three is going to be any online platform or anything that allows you to be a DIY, do-it-yourself investor where you can build your own investment portfolio all by yourself. Okay, so if we break those down even further, number one is your bank or your financial advisor. And once again, this is where traditionally a lot of people start, but it's also where a lot of people stay before they acquire more knowledge. So for example, this is actually where Steph started out. So when she was young, her mom took her to the bank, got her set up with TD mutual funds, and then later on we converted those to TD E-Series, and then now she's actually with a robo-advisor, which we'll get into in a second. Basically, the point that I want to get across, especially when it comes to investing through the bank, is that there's nothing wrong with it, especially if you're comparing it to not investing in the market at all. However, you do need to keep in mind that bank advisors typically have less options. They're usually licensed to just sell you mutual funds, and on top of that, there's a huge incentive for them to push those mutual funds to you because of those high management fees, right? Which we've talked a lot about on our channel in general. I think what we'll do is we'll link an article down in the description box below that outlines all the different fees that you will be charged should you take this option. And once again, this is essentially free money that you're giving to the bank when you could be managing this yourself, just, our opinion. So number two is an online robo-advisor, and we highly recommend this option because there's platforms out there like Wealthsimple that actually allow you to learn as you're investing over time. And assuming you choose the right platform or the right brokerage, you will end up paying lower fees than some of the more traditional options that are out there. If you look at some of these newer platforms, you'll notice that they're more user friendly. You'll notice that the user experience is that much better. So now number three is an online DIY platform, and basically this one's where you set everything up yourself. So this means you're funding the account yourself, you're making the investments yourself, and you're continuing that over the long term. So now this one's interesting because it can kind of blend with the other two. Like I can set up a DIY portfolio with my bank, but I can also do that with Wealthsimple. However, not Wealthsimple Invest, but Wealthsimple Trade. Personally, this is actually the option that I've gone with, so building out my own investment portfolio myself and making sure that I'm keeping up with the maintenance, so, rebalancing, whether it be once a quarter or once every single year. Basically, it's all up to you, right? If this is something that you're personally interested in, we've got another video that we did where I talked all about how I built my entire portfolio and the research that I did and basically everything in between. Okay, so once you make your option and you actually go through some of these steps, one of the next major things that you want to do is figure out your risk tolerance. Now, there are some online questionnaires that you can fill out. I know Vanguard has one on their website, but for example, if you're working with a robo-advisor, that is something that's going to be baked into their process where they ask you, what's your risk level? Are you comfortable with losing X amount of dollars should this happen? Are you comfortable with the gain of this amount of dollars should this happen? Once you've got your risk tolerance figured out, your next step should be understanding which account is going to be best to make those investments within. So this could be your RSP, it could be your TFSA. For all of our American viewers, this could be your Roth IRA versus your IRA. Basically, you need to make that decision yourself. Now, we do have a couple of videos on all the different accounts that we're gonna link up top for you to check out, but I'm gonna kick it back to Steph for her to finish off with the steps.
So now that you know where you're investing, how to set up your profile, and which account you want to invest in, it's time to actually fund those accounts with some money. So this amount of money is obviously based on your budget. And like we mentioned at the beginning of the video, it's really important to make sure that you paid off your debt before you start investing and that you have an emergency fund ready in your high interest savings account in case anything were to happen before you again get into investing. After that, it's not so much about how much you invest, but how consistent you are. So making the same contribution, if not a growing amount, month over month. And again, on top of that, the more you invest, the better. The more you can afford to invest, the better as well. And the more you can prioritize your investing early is also great because your money will grow more over time if you start out early. So I'm investing 33% of my budget every single month. Den's investing 44% of his budget every single month, just to give you an idea of how we're allocating our funds. We also both have set up automatic monthly payments to actually pull that money without us even having to think about it into our accounts each month. So in my case, I'm spending about 33% of my monthly budget on my investing. And again, I specifically have $1,000 being pulled out of my account on a certain day every single month and being put into my passive investment account. I don't even have to think about it. It's just going there automatically. So on that note, we want to give a huge thank you once again to Wealthsimple for sponsoring today's video. As you probably know by now, I've been using Wealthsimple to invest this year, and it's my passive investing platform and also robo-advisor of choice because it's so easy to use, user-friendly, simple to get started with, and they actually offer real human advice as well. So now let's actually dive into my passive investment account to show you what it looks like once it's all set up. Okay, so I've now pulled up my Wealthsimple Invest account, and I'm going to take you through some things in my portfolio. So again, right at the beginning, like I mentioned, simple to use. You can see how much I have in the account right now. At this moment in time, I'm actually down $29, but it's nice that I can see that very easily at the forefront. There's also a graph of how my money's grown over time. So something I'll point out is that you can actually see how I've consistently put $1,000 in every month from all those jumps up consistently over time. And again, so that's on the home screen. You can also click invest down at the bottom. It shows me that all of my money right now is in my TFSA. And if I click into there, you can then see how my funds are set up as well. So you can see my graph, what I've deposited. My goal is investing for retirement. It also easily tells me how much room I have left in my TFSA as well, which is great. I can contribute $34,000 more, which I'm working on. And at the bottom, you can see I still have my portfolio set up to be 80% equity, 20% fixed income. Again, if I click in there once again, you can move towards the bottom where it shows you your portfolio holdings and exactly how that 80-20 is allocated. So all of it's in here, just clicking through until you get what your breakdown is. So again, you can also see the market value. So if I click on international equities, which is 20% of my portfolio, again, something to mention is that all of this is automatically invested with the robo-advisor. So I'm just funding my account with the $1,000, and these allocations are happening without me having to go in and do them myself. But like I'm showing you right now, I'm able to click in and see what's happening. So like I mentioned earlier, if you are looking to set up an account, we do have an entire video dedicated to showing the Wealthsimple platform, a tutorial, and showing you step-by-step how to get started. So if you're interested in that, we'll have it linked above and in the description box below for you to check out after this one. We'll also have links down below that will give you cash bonuses if you use our links to sign up, again, for both the Wealthsimple Invest and their trading platform as well. So make sure you check those out too after this.
Alright guys, so that's a wrap on this video. We hope that you enjoyed the basics of passive investing. For anyone who hasn't seen our previous video on trading, make sure you check that one out next. Another huge shout out to Wealthsimple for sponsoring this video, and as usual, we'd love to hear your thoughts, your comments, all down in the comment box below. We do have some cool videos in the pipeline coming up, so once again, make sure you do subscribe and show us some love with a like down below. And if you haven't checked out some of our previous videos, make sure you do check them out next. And we will be back. You know the vibes, and let's go.